Hey, thanks for being here. I'm Trent Grigorchik, and I run a retirement income practice through Savvy. And over the next few minutes, I want to walk you through something I think is genuinely underserved in financial planning, which is how to actually turn what you have saved into a paycheck you can trust. I'm not going to pitch you anything today. Think of this like a retirement income audit, a chance to look underneath the hood at the system behind the paycheck, not just the portfolio behind it. Now, I designed this presentation for a very specific person. If you're somewhere between 55 and 65, you've built a portfolio in the $2 to $10 million range, and you're either close to retirement or you've recently made the transition into retirement. Everything we're going to cover today was built for your situation in mind. You're not starting from scratch. You've already done the hard part, but now the game has fundamentally changed, and the skills that got you here, discipline, consistency, long-term focus, those are still important. They just need a different framework around them. So here are the questions I hear almost every first conversation. And I want you to notice whether any of these land for you. How much can I safely spend? Not in general terms, but specifically with my portfolio, with my tax situation, with my timeline, because you'll be fine is not a number. It's a system. It's a hope. Will taxes erode what I've built? Most people think about taxes once a year, around April 15th, or maybe a little bit earlier. But in retirement, the wrong withdrawal from the wrong account in the wrong year can cost you tens of thousands, if not hundreds of thousands of dollars. Nobody flags it until the damage is already done. And then the third is, my portfolio actually built for withdrawals? Or is it set up like I'm 45 and still accumulating? These aren't hypothetical questions. They're the ones that keep thoughtful, successful people up at night. And they're exactly what I'm going to address today. Here's the thing I want you to see. Having a good portfolio is not the same thing as having a plan. I sit down with people all the time who have well-managed investments, sometimes with great advisors. But when I ask three simple questions, the answers reveal a gap. Do you have spending rules? Meaning, is there an actual system that tells you how much you can withdraw this year and what triggers an adjustment? Usually the answer is no. Do you have a lifetime tax map? Not just a CPA doing your taxes, but a multi-year strategy for which accounts to draw from, in what order, and in what years? Almost always they answer no. And have you stress tested what happens if you retire in a bad market? Not just a Monte Carlo with a green check mark of probability, but an actual look at your plan and how it holds up if the first 3 years just go sideways or downwards. The point here is simple. A portfolio without these three things isn't a retirement plan. It's a pile of money with no instruction. So here's the roadmap. We're going to cover 3 pillars today. First, the retirement paycheck. That's your retirement spending system. The guardrails that tell you how much you can take and when to flex. Second, your lifetime tax strategy. This is the piece that probably has the biggest dollar impact and gets the least amount of attention. And third, a portfolio built for distribution, because the way you invest while you're spending down is fundamentally different than the way you invest when you're building up. 3 pillars. Let's get started on the first one. Before we jump into the pillars, I want to name something that I think doesn't get said clearly enough. There is a fundamental shift that happens the moment you retire, and most people feel it, even if they can't quite articulate it. Look at this side by side. On the left, accumulation, that's what you've been doing for 30 or 40 years. Contributions going in, optimizing for max return. The goal was simple, grow the pile. On the right, distribution. Now it's withdrawals going out. And the goal isn't to max return anymore. It's resilient income. That's a different optimization entirely. And here's why this matters. You've been trained for the game on the left. Every piece of financial advice you've ever received was designed for accumulation. But retirement is a different game with different rules. And most people in this room have never been taught how to play it because nobody needed to teach you until now. All right, pillar 1, the retirement paycheck. I like to think of this as replacing the paycheck your employer used to send you, except now it comes from your own wealth and it needs to last 30 years. The foundation of the whole system is something that we call guardrails. And the concept is actually really intuitive once you see it. Instead of giving you just a single fixed number, like you can spend $90,000 a year, period, we set a flexible range. Think of it as driving on a highway with guardrails on both sides, right? There's a lane and you stay in the lane and the lane adjusts. In good markets, you give yourself a raise. That's not reckless. That's the system telling you that you've earned it. In bad markets, you pull back slightly. Not a lifestyle overhaul, not like eating rice and beans or going back to the spaghetti years, but a measured temporary trim. And when you're in between, you just keep living your life. No changes required. The beauty of this is that the decisions are already made before the emotions hit. You're not sitting there in a down market trying to figure out what to do. The framework already told you. So why do guardrails work so much better than a fixed rule? 3 reasons. The first, they prevent panic cuts. When the market drops 20%, your gut says, stop spending, right? The guardrails say trim 8%. It's a very different response, and it's almost always sufficient. Second, and this is the one people actually don't expect, they prevent underliving. I see this constantly. People with $4, $5, $6, $10 million who are afraid to renovate their kitchen or take their kids on a trip. The guardrails give you explicit permission to spend when the math says you can. And third, rules reduce emotional decisions. You're not white knuckling your way through every market headline. You have a system. You trust it. And that changes the entire experience of being retired. Now, I know what some of you are thinking. This sounds like a bit like what an annuity promises. And I understand the comparison, but I want to draw a clear line here. With guardrails, you keep a cash runway of 12 to 24 months, give or take. That's your near-term spending, and it gets refilled naturally from dividends, interest, and periodic rebalancing. So you get the predictability of a paycheck without handing your money to an insurance company and losing access to it, okay? Full flexibility, full liquidity, no surrender charges, no 10-year lockouts, and all that nonsense. And here's the thing that really matters. Life changes. Your spending needs at 62 are different from 72 and 82. An annuity doesn't adapt. A guardrail system does. The next layer of your retirement paycheck is income sequencing, which means the order in which you draw from different accounts. And the order does matter much more than most people actually realize. Generally, you start with cash and taxable accounts. These are the most tax efficient dollars to spend first, typically. Then during the low earning years or low tax years, often that window between retiring and when Social Security and RMDs kick in, you draw strategically from your IRAs and your Roth accounts. Those you preserve as long as possible because they grow tax-free and give you the most flexibility down the road, both for spending and for legacy. Get this sequence wrong, and over a 25 to 30 year retirement, you can end up paying hundreds of thousands of dollars more in taxes than you needed to. And your Roth accounts, those preserve as long as possible because they grow tax-free and give you the most flexibility down the road, both for spending and for legacy. If you get this wrong and it's over a 25 to 30 year period, you can end up paying hundreds of thousands of dollars more in taxes than you needed to. If you get it right and your money lasts longer, your tax bill stays lower, and you have more options at every stage. Social Security deserves a quick mention because it's one of the decisions that looks simple on the surface, but has a real downstream consequence. The key insight is that Social Security doesn't exist in a vacuum. It needs to be coordinated with your withdrawal strategy. Delaying your claim can meaningfully raise your guaranteed floor income. But delaying only makes sense if you have a clear path for how to fund those gap years while you wait for it, right? So we test the break even. We model the tax impact. And for most people at this level of wealth, the optimal Social Security isn't the obvious one. It depends on the full picture. All right, we're moving along. Pillar 2. And if you remember only one thing from today, make it this section. Your lifetime tax strategy is often the single highest leverage piece of a retirement plan, and it's the one that gets the least amount of attention. All right, so here's the big idea. There's a window of time, and it's usually opens the day you stop working and closes when Social Security and RMDs kick in, where your taxable income drops significantly. For a lot of people, that's roughly age 60 to 72 or 73. And during that window, you're often in lower tax brackets than you were during your career, right? Because you don't have any income. And lower than you'll be later when RMDs and Social Security starts to kick in, right? So these may literally be the most valuable tax years in your entire life. And what most people do during this window is nothing. They just take withdrawals as they need them. Maybe their CPA files their return. Nobody thinks about it strategically. That's a massive missed opportunity because a dollar saved in taxes during this window doesn't just save you money, it stays invested and compounds, and you never have to earn it again. And this is where Roth conversions come in. And for people in your position, this is one of the most powerful tools available. Roth conversion means you take money from a traditional IRA, pay tax on it today at today's lower rate, and move it into the Roth where it grows tax-free forever. Why bother with that? 3 reasons. First, you shrink your future RMDs. Every dollar you convert is a dollar that wouldn't be forced out of your IRA later at a potentially higher rate. Second, you manage IRMAA. That's the Medicare surcharge that catches a lot of high net worth retirees completely off guard. And third, you're creating a tax flexibility. Roth dollars are the most versatile money in your portfolio. No RMDs, no taxes on your withdrawals, and they pass to your heirs tax-free. This is where it all comes together operationally. Withdrawal coordination means that each year we're being deliberate in blending income from different sources, some from taxable, some from IRAs, and then some from Roth, to fill your taxable brackets intentionally. The goal is to avoid what I call the hidden tax spikes. These are the years where a clumsy withdrawal bumps you into a higher bracket, triggers an IRMAA surcharge, or makes 85% of your Social Security taxable instead of 50%. None of this is obvious. It's all blurred in the tax code, and it can cost you serious money if nobody's watching for it. Take a look at what's on the screen here. On a $4 million portfolio, the difference between strategic withdrawal coordination and just pulling money from whatever account feels convenient can be over $600,000 in lifetime value. That's not a hypothetical, that's math. And tax planning doesn't stop with you. There are 2 pieces here that almost never get attention. First, their surviving spouse problem. When one spouse passes, the survivor starts filing as a single filer. So their survivor can end up in a meaningfully higher tax bracket at the worst possible time. We can plan for that now. Second, beneficiary taxes. The Secure Act changed the rules. Most non-spouse beneficiaries now have to empty an inherited IRA within 10 years. If your kids inherit a $2 million IRA during their peak earning years, that's a massive tax hit. Roth conversions today can be a powerful design tool and reduce that burden for the people you care about. So here's pillar number 3, your portfolio. But I want to be really specific about what I mean here. This isn't about whether you own the right stocks. It's about whether your portfolio is built to pay you reliably through good markets and bad markets. This is the chart I want you to really sit with for a moment. It shows something that's called sequence of returns risk. And it's the reason retirement investing is completely different, and it's a different discipline than the accumulation phase. So here's the setup. There's 2 different portfolios here. One is balanced and one is growth focused. The gold line there is a balanced portfolio. The green line is the growth focused. $1 million, $50,000 per year in distributions, and As you can see, one portfolio does fairly well and actually grows over time, and the other portfolio runs out of money by around July 2016. And this is real back test. This is a real back test of full stock portfolio. The other is a mix of different asset classes. And the difference is how much risk you're taking on in your retirement portfolio and making sure that you're not taking on too much risk when you're taking out money in a fixed amount every year. So there's two lessons to learn here. One is making sure that you have a dynamic spending approach. Two, that your portfolio is actually set up to give you that resilient income stream that you need, and that you don't have to worry about that green graph and being in that scenario. And here's the uncomfortable truth. You can't control the timing. You can't control whether you retire into a bull market or a bear market, but you can control how your portfolio is structured to absorb that risk. That's what the next two slides are all about. The way we solve for sequence risk is a 3-bucket structure. Each bucket has a specific job and a specific horizon. Bucket 1, protect. This is 1 to 3 years of cash and short-term bonds. It's your spending money when markets are down. This is what you're living on. You never have to sell equities at the worst possible time. Bucket number 2 is sustain. This is your income core, right? Intermediate bonds, dividend-paying investments, income-producing investments. This covers roughly years 3 through 10. Bucket number 3 is what we call grow. It's the long-term equity, money you won't touch for a decade or more, which gives you time to ride out the volatility and to compound. When this bucket has a great year, we skim the gains, refill the other 2. When it's down, we leave it alone. And this brings us to something that is easy to overlook, but might be the most important, the behavioral piece. We preset rebalance rules. The system already knows what to do when equities are up 20%, take some gains and refill cash. It already knows what to do when the market drops. Sit tight, spend from the runway, no phone calls, no emotional decisions, no selling at the bottom because CNBC said something alarming, right? This is what I mean by behavior by design. The rules beat reactions every time. And for people who are analytical and like systems, which I suspect describes most of you listening to this today, this is incredibly freeing. I want to address something I hear a lot. People say, I'm pretty conservative with my investments, and they say it like it's a strategy. But here's the distinction I'd push you to think about. Conservative with an income plan and a structure behind it, that's resilient, that's strong. You can absorb shocks and keep going. Conservative with no plan, no spending rules, no tax strategy, no bucket structure, that's actually fragile. You might not lose 30% in a crash, but you might quietly run out of purchasing power over a 25-year period because your portfolio can't keep up with inflation. What we're aiming for is stability, not stasis. The goal is a portfolio that supports your income through whatever markets throw your way, not just one that avoids going down. All right, let's bring it all together. 3 pillars, each one solves a different problem. Guardrails gives you spending rules. You know your range, you know when to flex, and you're never guessing. Your lifetime tax strategy gives you a map, which accounts in what order across which years, and your distribution portfolio supports the income it's structured to pay you, not just grow. In one of these, any one of these is valuable on its own, but the real power is how they work together. The withdrawals are coordinated with the tax plan, which is coordinated with the portfolio structure. Any one of these is valuable on its own, but the real power is in how they work together. The withdrawals are coordinated with the tax plan, which is coordinated with the portfolio structure. That's what makes the system resilient. Before we start to close, I want to quickly name the 3 most common ways I see retirement plans break down. because knowing what not to do is just as valuable. Number one, guessing at withdrawals. Just taking what feels right instead of what the math says is sustainable. It's the most common mistake and it compounds every single year. Number two, 1 year tax thinking. You file in April, your CPA tells you what you owe, and nobody thinks about it again until next year. And retirement tax decisions need a 10 to 20 year horizon. The best moves are proactive, not reactive. Number three, optimizing for performance instead of purpose. Chasing the best returns when your portfolio should be optimized for income, tax efficiency, and stability. Returns matter, but they're a means, not the goal. So what can you take away from today, even if we never speak again? First, think about your personal guardrails range. What is the floor? What is the ceiling? If you don't know those numbers, that's the first gap to close. Second, sketch out a draft tax sequence. Which accounts will you draw from first and why? And third, do a portfolio stress test if you retired into a 30% drawdown tomorrow. How many years of cash do you have without selling a single share of a stock? Those three questions will tell you a lot about where you stand. The people who get the most out of this kind of work tend to share a few things in common. They're thoughtful planners. They want clarity more than they want products, and they value flexibility. They want to understand the architecture of their plan, not just trust that someone is handling it. If that sounds like you, then what I'm about to share is going to be relevant. Here's my invitation. I offer a private one-on-one session called a Retirement Income Strategy Session. This is where we stop talking about frameworks and start plugging in your actual numbers, your portfolio, your tax picture, your timeline. This is not a sales meeting. It's a planning conversation. And by the end of it, you'll have more clarity about your retirement income than most people get in the years of working with an advisor. Specifically, we'll build out three things: your personal spending guardrails, your 10-year tax window, including whether Roth conversions make sense for your situation, and a look at whether your current portfolio is structured for distribution. All three tailored to you. A few quick logistics. The session runs anywhere from 45 to 60 minutes. If you can bring your financial statements or information, you'll get a quick form to fill out in advance. So we're working with real numbers, not estimates. And I want you to be clear, this is a planning first, no pressure session, all right? If it does make sense to work together after, great. If not, you'll still walk away with a better understanding of where you stand. I'll leave you with this. You built it. You spent decades putting this together. The career, the savings, the discipline. The hard part is genuinely done. The question now isn't whether you have enough. For most people in this room, you do. The question is whether you have a system that lets you use it with confidence, with clarity, and without the constant second guessing. That's what a resilient retirement paycheck is, and it is available to you. If you'd like to take the next step, you can book your session right now. The link is on your screen. I'm looking forward to it. Thank you so much for your time today.